Hello, my name is Dr. Paul Cottrell. I'm going to go over the markets today, a little bit of an update where I think things are going to go, and then we're going to go over a video by CSIS about the energy sector. Thank you for joining. Please help support the work that I do by going to my website, the-studio-reykjavik.com, and donate. You can donate through Stripe, Buy Me a Coffee, or PayPal. So please help support the work that I do. Share the links and ask your social media to follow me. You can follow me on YouTube, Brighteon, Bitchute, and Rumble. All the links are in the description of this video. You can also follow me on TikTok, X, GETTR, Substack, and you can be a paid member to my Patreon channel. All these videos are for free, so please help support the work that I do. You can also get great products that I have on my store. You can get ebooks about finance and different topics on science and artificial intelligence. And you can get great supplements. These are supplements that I take regularly to help slow down the aging process. I have structural nano silver toothpaste. I have Max 35 and Cleanse to help boost up your innate immune system. Structural nano silver gels in stock that will help to heal wounds. You can use it as a daily skincare. Be prepared for the allergy and the cold season. I also have lozenges in Manuka honey and in vitamin C, orange splash, and I have probiotics in veggie cap. I also have C60 in a 2 ounce, 4 ounce, or an 8 ounce configuration. You can get it in extra virgin olive oil, avocado oil, or MCT coconut oil. C60 is a very potent antioxidant. It'll soak up free radicals, help to boost up your energy levels by increasing the health of your mitochondria. It'll also help with your immune system, endocrine system, cardiovascular system, and also the basal layer for your skin. I also have vitamin D3 that will help with bone density, also cardiovascular health and immune system. Vitamin C and magnesium boosts up the immune system, skin health, and brain function. Omega-3 helps with the cardiovascular system. Ashwagandha root helps to control blood glucose levels and cortisol levels. Good night formula helps you to get into 3 to 5 cycles of REM sleep and deep sleep. So you're consolidating memory and detoxifying your central nervous system. I have a probiotic in a powdered version. Resveratrol helps with your skin, but also with youthful gene expression. Vitamin B complex revs up your cellular metabolism, boosts up energy levels, and protects neurons. Turmeric brings down inflammation, soaks up free radicals. Magnesium and zinc boosts up the immune system and your brain function. Lignans helps with the immune system and endocrine system. Collagen helps with your musculature, your bone density, your joints, also your skin, nails, and hair health. Digestive enzyme complex helps to break up proteins, carbohydrates, and lipids. Clarity factor helps with brain function and helps you to concentrate. Olive leaf extract helps with the immune system and the cardiovascular system. Zeolite helps to detoxify your body from heavy metals, toxins, and chemicals. Myotrol helps to build muscle and maintain muscle. It is perfect for individuals that are 40 years of age or older. Do some resistance training, take the Myotrol. Boomer Boost is a great supplement to take to help to slow down the aging process. It boosts up your cellular metabolism. It revs up your energy levels. It helps with cardiovascular health, musculature, brain function, and it helps to slow down the aging process. You can use this as a multivitamin, your daily multivitamin. Gladiator barley and heirloom barley help to detoxify your body, bring down inflammation, and soak up free radicals. Gladiator barley has one added benefit over heirloom barley, and that is to build muscle. So if you want to build muscle, take the Gladiator barley, and you can stack it with the Myotrol. Gladiator barley and heirloom barley also stack very well with Boomer Boost. Collagen helps to remodel your joints, especially through a sports injury or arthritic joints. It's a great way to remodel those joints and heal them. And super strong relief helps to reduce pain in arthritic joints, muscle pain, tension headaches, sprains. It's perfect for temporary relief. It works within about 90 seconds. I also have ubiquinol, which is the most bioavailable form of CoQ10. It's an antioxidant and boosts up energy levels. NAD plus boosts up energy levels and helps to repair DNA. And nattokinase helps your cardiovascular system and break up clots. I have anti-aging boxes curated at different price points, such as the anti-aging deluxe box, where you get max 35, C60, D3, vitamin C and magnesium, structural nanosilver toothpaste, probiotics, resveratrol, and it's a great way to start on your anti-aging journey. They're at a lower price point compared to buying them separately. You can also get the longevity boxes, such as the longevity immune system box, where you get lignans, turmeric, and olive leaf extract. So it's a great way to start on your journey. You can buy them separately, but this is a great way to start that anti-aging process. And I have classes on pulmonology and immunology. You get a lot of videos, a lot of PDF files. You can learn it at your own pace. It's only $25. You get a unique password. You log in under classes with that unique password and learn on your own. So with that, please go to my store, the-studio-reykjavik.com, and get the great supplements that I offer. Now we are going to look at the charts, market. This chart is the SPY, which is the ETF for S&P 500. You can see that last week we've been trading down. We're at 765.72. The high point was 779.37, just under the 780 mark. We have a resistance level at 780 right now. I have a year-end target between 780 to 800 for SPY, which would equate to about 8,000 to 7,800 for S&P 500. This reduction in price for the last week or so has been with the issue with the Middle East, and also tech started to sell off a little bit, and the issue with the bond market. Jackson Hole meetings are going to be taking place this week. I think it's Wednesday is when Warsh speaks. I think it's Wednesday. Maybe it's Monday, but I think it's Wednesday. But either way, this week is going to be a big Fed week because of the Jackson Hole Economic Conference. So stay tuned to that. We've almost mean reverted back to the gap up. Normally, when you have a gap up, like right here, it trends up and then comes back down and then trends up again. I have a feeling we're going to start to trend back up. Again, resistance level at 780. We have a support level. We have a support level at the gap up of about 760. We also have another support level at 708. That is the 23% retracement. And another very strong support level at the 38% retracement at 665. So if there's a major sell-off, time to buy would be at around 710 and around 670. The oil market, this is a day chart for the oil market. Each candle is a day of trading. It is trading in a range. If you've been noticing, about 2 weeks ago, we broke the 79 level, 79.62, and have been trading in between the 79.62 to 87.23. It has tried to break above it, and then it would close below it. So right now it closed at 86.67. So we have an 87.23 resistance level. Most likely it will break and be trading above that 87.23 and be trading at around 88. If we do break that 87.23 on the close, then the next resistance level is 90 and a very strong resistance level at 97.84, and that's based on this fib sequence. Now, support levels, you have right now 79.62, but if 87.23 breaks and it starts trading up towards 90, then that 87.23 becomes the new support level. Chances are it will break because of this trend. Natural gas has been, for the last few months, have been trading down on average, but it has been moving upward a little bit relative to 1, 2, 3, 4, relative to the 5 days, business days. So about last Monday, it's been trading upward, but there's an overall trend downward. Right now it's trading at 2.755, and it is hovering above that 2.5 range. That 2.5 is a support level. That's roughly the low point that took place around end of April. And as we move towards September, normally September, it starts to trend up. So there's more probability of it going upward than down. I would say that the range right now for natural gas is around 2.65 to approximately 2.85. So right now we're at the high point, or maybe a mid-range, maybe a little bit above mid-range. So there's probably a little bit of a move downward and a little bit move upward throughout the intraday trading. What I have done recently is put a hedge strategy where I'm longing and shorting natural gas to play those swings. Now, TYD is the belly of the curve. It's a leveraged ETF. Now, this ETF you can see that the solid line is the S&P 500, and the TYD is related to bond price. You can see that they're inversely related. But if you take a look at the correlation chart at the bottom, you can see that this year the correlations are much more positive than negative. Normally, let's say last year, it was more negative than positive. So we have a positive correlation this year. As markets go down, then the bond prices have also gone down. And when there's been a decent uptick, then also the bond prices have been going up. So this year has been more positive than negative in terms of correlation. Normally, textbook would be that the bond prices are negatively correlated to equities. So just be careful of that. We've been in a trading range for a few weeks now, and we have these fib sequences. You can see that the fib sequence is from the high point, roughly, to the low. This high point goes all the way back to a couple more years, not 2686. It's a little higher. This chart doesn't show it. But the point here is that this fib sequence, we're near the very bottom of it. So bond prices are probably going to go down more because of the yields are going up. the big story is that the Federal Reserve actually, not the Federal Reserve, the Treasury Department intervened with the 10-year bond and um, bought to try to bring down the yield. The yields have been trading at around 4.6, 4.7. They tried to bring it down by buying bonds, and they would finance that by selling in front of the curve. So they're moving the duration of the debt. So that increases the Treasury's risk exposure. They prefer to sell the 10, the 20, the 30, but they're moving closer to the front end of the curve. Now, when they do that, that's going to raise the yield on the front end of the curve and uh, put some pressure on the Federal Reserve to having to lower rates. But if inflation is the problem and the Fed decides to raise rates, it's going to cause a interest rate risk as we continue to sell bonds in the front of the curve to try to engineer this this belly of the curve strategy from the Treasury. Most likely, this intervention is going to fail, and the bond market will win. Now, what does that mean for TYD? It means that most likely we're going to be testing the 2238 level and break it, and we should see this go down. TYO, I believe, is the inverse ETF. Now, the question comes in, if the equity market starts to sell off even further and go to 7,200, what will the bond market do? Will it continue to sell off or not? It's hard to say. I don't know, because what's affecting the bond market is the crowding out from corporate debt to finance AI, the inflation that's taking place in the economy, plus the problems in the Middle East, and the intervention in the currency markets, especially with Japan. So there's some worries that could perturbate the 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 price of the bond market and further drive yields up, which would drive price of the bond down. This chart shows quite a bit of information. You have the 30-year yield, the 10-year yield, and the 2-year yield. And this curve right here is the Federal Reserve rate. Then we have spreads between the 210 and the 3010 spread. So the 210 spread is at 0.5 and the 1030 spread is at 0.54. Now, what is that? What are we seeing in these charts here? We're seeing that yields are popping up again. Overall trend is yields are going up. We have the 30-year yield at 5.23, and we have the 10-year yield at 4.69, the 2-year yield at 4.19. You can see that the front end of the curve was starting to drift down a little bit. The 10-year was staying roughly steady at around the same time period, going back to mid-July, but the 30-year kept on creeping up. So you had somewhat of a steepening of the curve, especially to the 230 range. So right now, it is very possible to see the 10 yield, even with the Treasury trying to intervene, it has lost some of its gains of what the Treasury tried to do. And the yields are starting to tick back up. You can see that the yield went down and then it started to tick back up. So it's about halfway to where it was before the Treasury intervention. So we could see a 4.8 pretty soon here. The high was at 4.75. I think the Treasury Department is very scared of a 5% yield on the 10-year. That would mean that the 30-year would creep up to 5.75 to 6. And most likely, depending on what the Federal Reserve does, if the Federal Reserve decides to raise rates, we may start seeing a 4.5 on the 2-year. This is getting a little scary in terms of the bond market and the way we finance our debt. And our debt is 122% of our GDP now. The VIX index uh, measures volatility for the S&P 500. It's relatively low. And when it stays low, usually the market starts to creep up. So most likely what will happen is the S&P 5, if it stays low, the S&P 500 is going to continue to creep up to that 780 mark and test it again. Now, it normally spikes, and it's been spiking. Let's say here was a intra-month spike, but if you take this one out and you go from this spike to this spike, you're talking 1 month, almost 2 months. So from this spike to the next spike, you're talking about the end of September, maybe the mid-September. We may start seeing a 20 level VIX. So that would mean approximately that the movement of the S&P 500 over the end of September, we may actually see it test that 7,800 for the S&P 500. This line here, this solid line is the S&P 500. I'll just go to the SPY as a better chart to look at. If you can see that this is about a month's activity. All right, we could be testing it by the end of the month, creep up to 780, maybe even surpass it, but the VIX will start to creep up close to 20, and then the market would sell off. So I'd be a little bit hesitant going into mid-September that this is a little too low. This is probably going to creep back up to 17 soon. But this is way too low. It doesn't stay that low for very long. And when it does, boom, it pops up to 20. And it starts to creep up. Here's a perfect example of the beginning of the year and how it started creeping up, and then it spiked above 2. It comes down to 15 and it spikes back up above 20. So it should be spiking above 20. Probably, I'd be concerned mid-September, end of September, because of that normal 2 to 2.5 month from high to high with the spike from one spike to another spike. And the last major spike took place at the end of July. So if we don't have another spike in August, we're looking at mid to end of September. ERX is a leverage ETF, 2 times leverage for the energy market. It is a bullish ETF. ERY is the inverse, where you're bearish on the energy market. And you can see as oil has been going up, this energy ETF has been trending up. Now they've been testing that 80. Remember when I was saying it was testing that 87.23 level? Some energy has been ticking up. The oil's been ticking up. So, and testing the last 2 trading days, it's been testing that 87.23 and been having a little bit of a problem. You can see here on the energy ETF those last two trading days, it tested and then came back down. So it's testing that high point that it had at roughly at 111 for this ETF. If energy breaks that 80, if oil breaks that 87.23 level, this is going to pop above 111. So there's a high probability because of this gap up, because oil is probably going to be trading above 87.23 this week. Most likely this will go up. If it doesn't, then it'll come back down and it's going to probably go below the 105 mark. And if 87.23 for oil fails, then ERY, ETF, is probably going to start to go up. And that's trading at approximately 9. I don't have a chart for that right now. So that's the overall view of the markets that I wanted to talk about today. Now what we're going to do is play a video by CSIS about the energy markets.
Good morning and welcome back to Energy Shots. I'm Joseph Mikett of CSIS. Today we're going to do an update on what's been happening in oil markets, fuel prices, and the Strait of Hormuz. Kevin, good morning.
Good morning, Joseph.
What have you got on your mind, sir?
Well, I have a milestone for you. Maybe you'll have the camera focus in on this. This is Benjamin. Benjamin Franklin, one of our founders and framers. It's also the spread, the diesel crack or margin between the price of diesel trading in the market and the price of crude oil used to make that diesel. And a record hit on Monday, $100 per barrel diesel margin.
And what does that tell us about what's happening in the oil markets right now?
Well, you can think of that as a measure of profitability. We did that discussion a couple of episodes ago, but it is also a marker of acute scarcity. And so it all starts with the inventory story, doesn't it?
We all know the story now at this point. The Strait of Hormuz has been kind of closed, maybe back open, but frictional. Oil market, we've been eating into inventories for now going on 6 months.
So this is one of those 5-year charts. We'll have a lot of them in today's episode. So the gray area is the 5-year range from 2021 through 2025. The orange is the calendar 25 trend line, and the blue is year-to-date calendar 26. And what we're looking at is the IEA, the International Energy Agency's estimate for where global petroleum inventories observed everywhere on the water, all the places they can see them have gone.
And this is crude, products,
yes,
everything.
All the barrels stored all the ways.
Right.
And what it shows us is that we've seen about a 410 million barrel decline from February through July, which is the blue line. And if you look at the build that had been happening last year, this steady orange line cruising up, and of course where we're starting here, cresting in February before we start the decline, you can see that there was a massive build followed by a steep decline.
Now, there's only one thing I want to ask you about. When I look at this chart, I look at the blue line and I say, okay, we were continuing to build in February. The war started, Strait of Hormuz became victim to it, and then this line is starting to trend downward, maybe a little bit faster than we would have thought. Are we eating into the buffer?
We are eating. So the International Energy Agency is very conservative.
Yeah.
There are numbers that are deeper than this estimate. They also project by the end of the year it'll get to something like 600 million barrels. The Energy Information Administration, the U.S. Statistical Agency, has a 4.2 million barrel per day second quarter decline rate and a 3.8 million barrel third quarter decline rate, and that adds up to 700 million barrels sort of over a different 6-month interval.
Right.
And so by year end, if that trend would continue, it would be even further. But yes, the answer to your question is if we have a gap between supply and demand, because something's not going the way it used to go, then you should expect inventories to decline. And this matters for a reason we've discussed before, which I think will seem familiar to a lot of our longtime viewers, and hopefully there are a lot of longtime viewers. We're glad to have you. This is the inverse relationship between petroleum inventories and prices. And so the orange line here is the dated Brent price, and the blue line is the global observed inventories. And we've shown this in the past with different different subsets of the global inventories. So the OECD inventories have a slightly tighter correlation, tighter inverse correlation, but negative 0.65 is what I would call meaningful. When inventories go down, prices tend to go up. And so the fact that we're seeing depletion of those inventories is really means that we're expecting prices to continue sort of creeping up.
And that's what we've seen over the last few weeks, correct?
Yeah.
We're not seeing like dramatic price increases. We're not seeing some sort of normalization between what we hear about as delivered prices versus the Brent price. But we are seeing the Brent price sort of steadily rise.
Yeah, so yesterday, Secretary of the Treasury, Scott Bessent, was on CNBC previewing an economic fury escalation on Monday. And he said, the price is rising. Well, it shouldn't be, because the fact that we're using economic pressure is a sign that we're probably not going to need as much kinetic engagement, and therefore risk to supply. But of course, that effect in the foreground, we'd probably see a much steeper increase in price if there were kinetic engagement. What we are seeing is this effect of inventories depleting. Now, the thing about inventories is, how many barrels of crude oil have you put in your car recently?
0.
Right. So products matter, and product types matter. And so this is where we get into the refined products.
Yes.
Right? It is a fuels crisis that we are feeling most acutely. When we talk about $100 diesel margins, we are talking about refinery capacity going offline. So this is IEA data from their oil market reports. The orange shows the series estimated through July. The blue is their projection through November based on the August data, the most recent they released. And the delta versus a year ago in June bottoms out at 6.1 million barrels per day of throughput through the global refining system missing offline. There's reasons such as Russian refineries offline because of Ukrainian drones. There's reasons like damage to Middle Eastern production capacity, loss of export volume through the Middle East, also processing that couldn't happen in Asia because the crude barrels weren't getting to those refineries.
Right.
And so it gets to a little bit less steep. It starts to climb back up. In July, we were looking at a projected 4.7, August 4.3 versus a year ago. Now, if you ask, okay, so how does that look when we get through third quarter, which is a critical time? Third quarter, the IEA is saying, well, we'll be about 4.1 million barrels per day on average versus a year ago of missing refinery throughput. Okay, what about demand? 2.4 million barrels per day of missing demand, which means that there's 1.7 million barrels per day of demand that doesn't have refinery throughput to satisfy it. And that, going into the October harvest season, the harvest feast we have at the end of October, bad ideas get harvested in October too.
Yes.
And I think we'll talk about this. October surprises happen in election years.
Yes.
October is an important month for a lot of reasons. But right now we're looking at inventories in the U.S. for that middle distillate, that whole category of fuels that includes diesel, especially. Again, the blue line is this year below the 5-year range, ahead of the logistics, use of diesel for harvesting,
right.
For that pumpkin, for your pumpkin spice latte, it doesn't harvest itself.
Right.
And the spices, they don't transport themselves either. You need fuels for that. And so this is the national picture. And it is a picture of significant 5% below the 5-year range, which I think at this point in the year really matters. Now, we can break it down by region. We'll do this quickly. In New England, where I think we think of sort of the Thanksgiving and other harvest feasts sort of getting their origin, the blue line is 21% below the 5-year range.
Oof.
Okay, so that is a stark distillate. It's not the first time we've seen this. We've seen shortages in the past. 2022 was such a time. We move to the mid-Atlantic. It's low, near the bottom of the range, and trending down. We go to the southeast. We've got a sort of a diesel drought in Dixie.
Oh my gosh.
And it's not that good when you look to the West Coast either. So out here on the West Coast, it's up and down. There's been some very, very low-level weeks. But again, data are a little noisy on a weekly basis. We'll get better data 2 or 3 months from now. But what this is painting is a picture of shortage. Now, the question I guess you might be asking is, so what do we do about all this?
Yeah, I think so.
Okay, so what do we do about all this? One of the things that keeps coming up, talking about bad ideas that could be harvested in October, is to put export limits in place.
Well, and that's, I think, really important, because one of the things that's driving this, because this is a global fuels crisis, is record U.S. diesel exports to other markets.
And that is actually where we are right now. We're at about 1.7 million barrels per day using those weekly EIA data, being exported on a 4-week average basis in the most recent calendar week through August 14th.
And from a market perspective, that's great. 500,000
barrels per day above the 5-year average through 2025.
Sure.
So that's a lot of incremental diesel going out the door. But of course that is, as you say, balancing the world, and balancing the world is bringing down prices for the world, and those prices impact the imports coming into the United States. So cutting those exports off could have second-order impacts that might not be that good. But there are other things one can do. This week, Energy Secretary Chris Wright was in Midland, Texas, when he said to reporters he was going to look at what we can do in the government to help refiners ramp up their throughput.
Yep.
Okay, so what can we do to help them ramp up? So really changing throughput in a big way over the long term usually involves something like change to environmental standards or tax policy, tradable environmental credits, those kinds of things. In the short term, there are relatively few things you can do. Fuel things is kind of a funny
my understanding is that the U.S. refinery complex is already running at very high capacity, has been doing so for some time, at least 6 months through this crisis. And the fall and the hurricane season for the Gulf Coast is not necessarily the best time to be needing to maximize throughput.
And it's also when you typically see refineries going offline, turning around to do maintenance. And so deferring that maintenance to take advantage of opportunity or to serve necessity may be part of what's in the cards. Deferring maintenance. So, okay, here's one of the things that the government could do.
Right.
The government could help to coordinate those turnarounds.
Yep.
They could say, we have the convening power, given the very significant antitrust concerns that it would obtain to refiners having a discussion about when they're going to turn off. You would need the government to have this kind of convening power and organizational authority. So maybe that's the sort of thing that government could do. Or another thing they can do, and they did it yesterday, the EPA decided that they would end the fuel specification for summer fuels, which require lower volatility gasoline, less evaporative gasoline, so that you don't have pollution and smog formation in the summer months. They would end it a couple weeks early. So usually that specification runs through the middle of September. Yesterday they said we're going to use waiver authority, an authority that's supposed to be for the direst emergencies, which is currently being used right now to allow for E15 waivers.
Yep.
We're going to use that authority to stop it so that on September 1st, I don't want to get too much into the weeds here, but so butane has a read vapor pressure of like 46 to 52 in that range, very high evaporative emissions. Butane is also cheap. It's about 10% of typical winter gasoline, falls to about 2% in the summer months. And then you have higher cost, lower volatility ingredients to go into the summer soup for the gasoline. And so if what you can do is you can get to the winter gasoline a little bit sooner, then you have some opportunity to bring prices down a little bit sooner for motorists. But that's not the same thing as making more.
No, it's not. And you know, the other side of this, which we really haven't seen much of a response from the government here or around the world, is conservation. I mean, if we're really in a situation where inventories, particularly for distillates, are falling well below 5-year averages, and there isn't much of a picture of them being restored immediately, why aren't we talking yet in the United States, or even I was in holiday in Japan? There's no discussion there, despite their importing half of the crude oil they typically do, of conservation. There's still price supports for consumers.
Yeah, it's very, very politically challenging to try to tell end users that they can't have what they want or they have to pay more for it. High prices tend to usher out elected officials before they usher in new technologies. You don't get reelected most of the time putting large people into small cars. This is a really touchy political issue. So I think you've seen, we did talk about some of the measures that the IEA had tracked several episodes several months ago, but it isn't popular. And it's also very difficult when you start seeing government intervention rather than market intervention delivering that kind of result, because now you have the opportunity for untoward results. When the government starts to constrain supply, you see hoarding behaviors and the exact opposite of what you're looking for.
Well, let's talk a little bit more about government intervention, because in the early part of this crisis, we had the release of strategic stockpiles from the OECD, governed by the IEA. The U.S. SPR was really brought as a tool to help solve the supply challenges of this problem. And there's been a lot of concerns about the state of the SPR It's an area in which you've spent a lot of time studying. Can you give us an update of where we are?
Sure. Let's take a look. So the orange line here is the level of inventory in the United States Strategic Petroleum Reserve, going down from 415 million barrels in the sort of the early March start of the decline from the drawdown to 293.4, if memory serves, right now. On its way down to 243 if we get to the full 172 million pledged as part of that IEA collective action. And currently, about 122 million barrels of that 172 have been released, so there's about 50 to go.
Now, what we're hearing is that the SPR is approaching operational limits, that it hasn't been this low since 1982, but you're showing you've committed the opposite of a chart crime. We start here at zero. And so there's still 100 and, what is this? What's the pink line here?
Pink line is the 243 where we will go if we hit the full 172 we promised.
So you're still talking about 243 million barrels of strategic reserve. Why are people getting so antsy?
Well, partly because this is a vital national security resource that provides our only insulation against supply losses that we control.
Right.
OPEC spare capacity is another one. So are the other IEA member country strategic reserves. But this is ours, and when it gets leaner, I think everybody says, wait, maybe that's not a great place to be, and that's a fair point.
Yeah.
But on the other hand, all infrastructure has operational minima. That's necessary to keep pressure to run. You have to have a certain amount of product in the system just to make it flow. But I think when you hear numbers like 250 or 300, that's not really an operational minimum issue.
Right.
What we're really talking about is the way the infrastructure performs. So if you read the annual reports that the Strategic Petroleum Reserve has made to Congress every year, for years and years, they say, well, you know, if you start to draw down inventories, you'll see a decline in flow rate. And that's intuitive, right, for a variety of reasons. And actually, if you look at what we've seen to date, since this drawdown began on the next slide, you'll see the flow rate declining. The blue bars are the weekly averages implied by the inventory levels the IEA and DOE are reporting, and the orange is the 4-week moving average implied flow rate, taking those blue bars and smoothing. And what you can see is that we're at about 600 and change, 1,000 barrels per day of flow right now, out of the 750 or so that the IEA says is still going for the remaining 100 million barrels going out.
Right.
So we're doing most of the lifting right here, but it's down from 1.2 million or so on that 4-week moving average basis earlier. So, but look, there's some limits to this.
Yeah.
If our problem is that we don't have enough refinery throughput, adding crude to the world is a helpful source of supply when we are short crude also, but it doesn't solve all problems. It solves one problem.
And what do you think the forecast for this might be? I mean, if we roll down toward our committed volumes, if we still have a frictional strait, is this going to remain to be a tool that you think the government's going to want to use? Are the OSED countries going to continue to collaborate on releases? Or has this tool have we kind of shot our wad and now we need to find other ways of balancing the market?
Well, look, there are real concerns about what happens when you get down to the actual operational minimum, which we think might be around 70 million barrels.
Right.
And of course, flow rate declining means performance, there's less to give to the world.
Sure.
Other countries are even more energy scarce and probably very reluctant to do another dip into their strategic stockpiles.
Right.
And no one knows when the crisis is going to end. What I will say before we get into what I think you have, which is the real answer for how we solve all of this, is just one other thing that government can do. And if you look at it, there are restarting idled refineries, right? You can give environmental waivers or financial support for refinery capacity. There's about 500,000 barrels per day, some of it in the Virgin Islands that's been talked about and restarted before, not always successfully. But there is capacity that can be brought on stream with financial support. On April 20th, the president put out a memorandum authorizing use of Defense Production Act Title III money to encourage refining and logistics. So there is some work that's been done on that. And of course, then, the real answer, I think, tell me if you disagree with this, would be to simply fix the strait.
Thankfully, there have been significant evolutions of what's happening in the Strait of Hormuz over the last few weeks that we've started to track here at CSIS, right? So, and I think it is actually incredibly important, Kevin, obviously, But because what is going on in the Strait right now is not immediately clear. A few days ago, the President Trump posted on Truth Social a new U.S. territory, the Strait of Hormuz. And what we've learned is over the past few weeks, the Navy has been running a escort and protection operation for commercial shipping. Now, this has been something we've talked about for months. It was on the minds of U.S. policymakers even in March and April of earlier this year. But it seems that this really might be setting in and helping to restore commercial traffic in the sort of post-MOU collapse, where in June we thought maybe the MOU and negotiations between Iran and the U.S. would open the Strait. Now it looks like we're going to have to do it by force. And there's been some debate as to what's actually going on.
More than a little debate, from what I've seen. The Secretary of Energy was out there saying, well, we've got numbers, and your numbers are wrong, because our numbers are right. And by the way, that doesn't strain my credulity to think that satellites squinting from space aren't probably as able to see what's going on in the Strait as the barrels on the water that the U.S. military is escorting and that the Secretary is privy to. But what have we here?
Well, so there's a high degree of uncertainty as to what's happening. Of course, now if the Navy is actually running 10 or 12 or 15 tankers out of the Strait every night under the cover of darkness with transponders off, you think they would be able to keep pretty good track of those barrels. But on the other side, there is a lot of information that commercial firms gather about what transits of Hormuz are at any given time, as you said, using satellite data, using other inferences, using information from the shippers themselves. And the disparity between what the administration say is happening and the U.S. government is saying is happening versus what the commercial world is seeing is quite stark. So what do we have here? We're looking at millions of barrels per day traveling through the Strait of Hormuz. This data comes from our friends at Vortexa, one of the best firms in sort of tracking tanker traffic. They every transit that they document has the name of the ship, its owner, knows its size, what it may be laden with. And what we're looking at here since the start of June is the daily flows through the Strait of Hormuz in blue, and in orange is the 7-day backward-looking running average. And this is where the divergence between what we're hearing from the USG and what commercial markets think is happening is getting quite stark. So if you believe over the last couple of weeks, the U.S. has been running a protection scheme, an escort scheme, similar to what we did in 1987, 1988, or what we've been doing in the Red Sea for the last 18 months, right? You would expect to see an increase in commercial flows. But in fact, starting at the end of August, you saw a decrease in commercial flows. And what Vortexa and the other firms that look at this are seeing 4 to 5 million barrels a day. Some may say 7 million barrels a day. It's very frustrating that it's hard to count all of it up. But when the administration is saying, well, actually, we think that there's closer to 10 million barrels a day, when commercial estimates are half of what the administration believes is happening, then it's clear why you're not seeing a market response.
Well, let me pause you there. Years ago, I used to give a speech. It was kind of a crowd pleaser. It was called How to Be Wrong About Energy in Just 9 Words. And I'll give it to you right now, the 9-word part. The first 3 words are significant government control, something we talk about all the time. The second 3 words are long infrastructure life. Easy to overlook how that can change things. But the third 3 words are limited data quality. This stuff is very, very hard to count.
It's incredibly hard to count. And here's like an interesting way of looking at it. This is coming from Vortexa as well. But instead of counting up the barrels in tankers, we're just counting tankers themselves. Again, this is daily outbound transits through Hormuz. And I'm showing you 2 things here. So the orange are the transits made by tankers who are going sort of lights on, is how I would say. Okay. Transiting through the Omani route, the southern side of the Strait of Hormuz.
With their AIS transponders showing who they are and where they are.
Exactly. Okay. And you saw that during the period of the MOU, that sort of the high points in June, commercial shippers were willing to use this route. And then as soon as attacks resumed, it drops off like a cliff. And there was a shift to what we call dark transits. AIS off, not announcing your course, maybe being escorted by the U.S. military. And here you're seeing roughly 10 on average in the late July and August, just below that, and then a shift down more toward 6 or 7 outbound transits per day. And this importantly includes ships that are trying to break the U.S. blockade and ship Iranian oil out of the Gulf as well.
So that...
And this number is much less than what we're seeing from the USG. Reporting from Axios earlier this week citing unnamed but credible sources within the White House.
More than 20, it says.
Said more than 20 ships were slated to move in and out of the strait through the southern lane.
And that number you just cited was 10.
Or possibly even less. Though I think to be generous, I think this and might be doing a lot of work, because if you have sort of 10 ships going out, or maybe just a couple less, if you have 10 ships or just a couple fewer coming into the strait to unladen to pick up oil and bring it back out, then you can kind of add to 20. But in that case, the and might be doing quite a bit of work.
You know, as one who writes research about very difficult to predict topics, I would also suggest to you that the word potentially can do some lifting. It's got some power.
Of course, yeah. If all of these were VLCCs and carrying enormous cargoes, then you might get to a 15 million barrel a day. So I think over the next couple of weeks, there's so much attention on what the U.S. has been able to achieve in terms of securing this shipping lane that we'll probably get some resolution. I think if the USG doesn't see the market response that they want to see, if it is true that we really have closer to 10 million barrels a day coming out of the strait in oil and products every day, that would really quell a lot of market nervousness about ongoing inventory depletion. But we need to see it. And if what we see, if it becomes very hard to prove that, then we're going to have to figure out where this potentially is doing so much work.
So I think what you're saying, Joseph, then, is that it's an important political question, who controls the strait.
Absolutely.
But it's also, from an economic perspective, it really matters how much is going through it.
It matters a lot economically. I would say it also matters politically and in terms of our national security strategy. Part of what the U.S. government is trying to do is wait out Iran. We're going to hear more on Monday about this new package of economic sanctions, but it's becoming a contest of who can tolerate risk and accumulating costs longer. The global economy and the U.S., which feels a responsibility for that, or an Iranian regime which is increasingly cut off but feels emboldened and empowered when it comes to disrupting shipping through the strait. And then, of course, there's a question of, if we are able to secure flows through the strait, sort of returning to the promise that the U.S. has had for the Gulf for the last 50 years, what is the cost of doing that? What are the naval assets and other military assets necessary? And how long is the U.S. going to be willing to do that? And who's paying for it?
All important questions that we'll look forward to discussing in the future.
Yeah, hopefully we'll have more information. We're going to be looking at some of that satellite data ourselves. So in future Energy Shots episodes, we might be able to delve in deeper. But as always, it's very interesting to follow these issues with you, Kevin.
I look forward to the next conversation.
The next conversation is coming up very soon.
Well, that is my review of the energy sector and what is happening with the financial markets and what the potential trading ranges are for the different asset classes that I mentioned earlier. Please help support the work that I do by getting the great products that I offer. Please visit my website, the-studio-reykjavik.com, and get healthy. These are supplements that I take on a regular basis. Thank you for listening, and have a nice day.